Hello everyone, I'm Mia, Mingzhu Yu.
I'm Sissy, Xuanzi Li.
I'm Jenny, Yuting Guo.
I'm Yuki, Zhiyu Liu.
Today we're going to talk about the benefits of managed funds and why choose them. The great German philosopher Hegel once famously said, "All that is real is reasonable, and all that is reasonable is real." In the case of managed funds, there are some good reasons behind its continued existence. Before we delve into the details of underlying rationale, it is necessary that we briefly discuss what managed funds encompass. What do we talk about when we talk about managed funds? A managed fund is one type of managed investment scheme that pools funds from many investors. A fund manager then buys and sells shares or other assets on investors' behalf. Investors are usually paid income or distributions periodically. The value of the fund investment will rise and fall with the value of the underlying assets. You may have seen words like mutual funds, hedge funds, superannuation funds, exchange-traded funds, etc. These are all varied forms of managed funds. Indeed, managed funds come in so many shapes and colors that it could seem overwhelming and confusing. For instance, mutual funds can be further divided into equity funds, debt funds, and hybrid funds by investment objects, or close-ended, open-ended, and interval funds by constitution. It is exactly the diversity feature that gives managed fund its biggest advantage over shares, namely a diversified portfolio.
What do you think of when you hear a big company names like Dick Smith, Ansett Airlines, Compaq, General Motors, and Conduct? The thing this company have in common is that they were all once listed in the stock exchange and they are all failed. It is crazy to think that 88% of the Fortune 500 firms that exist back in 1955 no longer exist today. If you had purchased the shares in any of the companies, these shares would have been worth nothing today, and your hard-earned money would have gone. Take Dick Smith as an example. As Australia's longest trading electronic retailer in a highly profitable and rapidly growing industry, Dick Smith employed over 3,000 employees and operated over 2,000 stores before it was placed under liquidation on 25 July 2016. Individual investors who bought Dick Smith shares conduct their research on the firm, while information released to the public by management and trusted auditing reports produced by top accounting firm Deloitte. These people did not see it coming, the total failure of the company, which cost them the entire of their investment. This just gives us a sense of the scale and magnitude of the risks and uncertainty facing retired investors when they choose a company and buy its shares. Public listed firms face both business risk and financial risk. Misjudgment, misinformation, misconduct, and mismanagement could all lead to business failure and bankruptcy. Due to the unique risk attached to any specific firm, investments rely on diversified portfolio in minimize unsystematic risk. Instead of buying shares, buying units in managed funds offer a convenient solution to immediate diversification.
The diversifying effect of managed funds move way beyond an equity portfolio of different companies from different sectors. Where there is a will, there is a managed fund. Investors benefit from a multitude of channels brought by the pooling effect of funds. For example, if you go to the website of BlackRock, which is the world's largest investment management corporation today, this is what you see on the homepage. BlackRock offers 72 funds to Australian investors which are categorized by asset, class, strategy, and region. In other words, by simply buying units in BlackRock's various funds, investors are able to buy both domestic and overseas shares. They can also buy into managed funds that specialize in fixed income securities, an asset class that is difficult to invest in directly, but is important given its defensive characteristics and non-correlation to equity markets. By buying units in real estate investment trusts, Investors with a small amount of capital could still acquire proportionate partial ownership in residential, commercial, retail properties or hotels, and therefore benefit from a rising property market. Additionally, shares in REITs, which are listed on a stock exchange, can be traded, giving it increased liquidity and lowered transaction cost over conventional property investment. It is also worth mentioning that managed funds open doors for retail investors, providing them a channel to invest in large-scale infrastructure projects such as toll roads, airports, and rail facilities, which would otherwise be inaccessible. Infrastructure projects are usually characterized by low levels of competition and high barriers to entry. Infrastructure funds attract investors who are looking for predictable returns.
In a relatively efficient capital market like ASX, information about economy, sector, industry, interest rate, foreign exchange rate, along with information specific to a company and its stakeholder will all be absorbed by market participants and then promptly reflected on the share price. While it is possible for individual investors to directly buy shares, it is difficult for them to know about the stock market and manage their stock portfolios for the best return. All work and no play makes Jack a dull boy. Anyone who has other commitments, such as a job or family duties, will find it extremely challenging to constantly monitor the market and act accordingly. This is probably why many astute investors choose professionally managed funds instead of buying in shares directly, as there is less stress and hassle. Fund managers and their teams often employ some of the industry's most groundbreaking technologies that individual investors simply don't have. One such case is quantitative funds that select securities using advanced quantitative analysis and software programs. The AI-powered equity ETF is an example of a quant fund whose investment strategies is determined by a proprietary quantitative model developed by Egbert with IBM Watson Artificial Intelligence. Entrusting expert fund managers who have the knowledge, experience, and resources can maximize investment return. Australia's top fund managers, like David Paradise and Peter Cooper, have all turned their reputable expertise and extensive experiences into outstanding performance.
With the help of managed funds, investors immediately diversify their portfolio across companies, industries, countries, and asset classes. Investors only have to choose the level of risk and return they are comfortable with and select from the abundant pool of managed funds. The minimum requirement on how much to invest is usually lower compared to direct investment. One can start investing with as low as $1,000 if continuous monthly contributions of at least $100 are made. This is a great way for young professionals with limited capital to start saving up for their first home deposit and growing wealth. More importantly, by reinvesting the fund's distributions, one will enjoy the magnificent compounding effect. Given all the benefits discussed, it is no surprise that this form of investment will continue to exist and expand. Thank you very much.